Hello, everyone. It's Professor Rako here. Thanks for tuning in. Today's lesson is on the accounting information system. It's the first of a series on this, the accounting information system and how we gather transactions and prepare our financial statements. So this first one you'll find is really just a review. All right. So in most intermediate textbooks, the first couple of chapters, depending how they break it up, will be discussing FASB and the standard setting process and the conceptual framework. So depending how the book breaks that up, this chapter that we're looking at here in most books will be either in the second or the third chapter. All right, so an accounting information system is just the system that gathers all the transactions for a company. So if you think about a company, they buy supplies, they sell inventory, or they perform services. They pay their employees, they pay utility bills. All those are just transactions that we need to account for in order to gather them and then eventually prepare our financial statements so that we can distribute that information to the interested parties, which may be regulators, investors, tax authorities, or whatever the case may be. So a double entry accounting system that requires that each transaction affect at least two accounts, meaning we need to have at least one debit and one credit affected in each of our transactions. Right. So we learned early on in our financial accounting courses, our principal courses, that our debits always have to equal our credits. Okay. Well, that is the same here. All right. So every transaction has to have at least one debit and one credit, and that some of those have to be equal. Now, there can be more than one debit or more than one credit as long as the debits equal the credits. All right. And so this ensures that our accounting equation, remember, which is assets equals liabilities plus equity, always balances, and we'll do more on that in the upcoming lessons. All right, so debit and credit. So debit just means left side, credit just means right side. Sometimes students, get confused on this because, we have the terms debit card, credit cards. We have heard the term they're going to credit my account. What does that mean? But for accounting, debit just means the left side of the transaction, and the credit just means the right side of the transaction. All right, so if you look at a T account, all right, so a T account, I'll just draw a line here. All right, so a T account is an account in the shape of a T where this left side represents a debit to an account and the right side is a credit. All right, so that's pretty straightforward. All right, the important thing to remember is that a debit can be either an increase or a decrease to that account depending on the account. We'll talk about that in a second. And that's the same for a credit as well. So a credit could be an increase for some accounts, but a decrease for other accounts. All right, so the key thing that we need to learn is the normal balance of an account. All right, so the normal balance determines whether the debit is the increase or decrease and whether the credit is the increase or decrease, right? So the normal balance is very important. Once you understand that, it helps you a lot with your journal entries or whatnot going forward in this class. All right, so if we look at it down here, taking this a little bit further. So now this is kind of our summary right here, and I'll go through a way that I think is, a little makes it easy to remember. But assets, meaning all assets, cash, inventory, land, equipment, all assets, all expenses, and our dividend account all have a normal debit balance. What that means is we're going to increase those with a debit. So if we have cash coming in, we're collecting cash, we would debit cash. All right. Liabilities, equity, and revenue accounts all have normal credit balances. So that means we increase those with a credit. So if we borrow money and sign a note that we're going to pay it back, that note payable would be a credit for whatever dollar value we borrow. So that credit would increase the note payable balance. All right, so one way I remember this is looking at the accounting equation. So if you remember, the accounting equation equals assets equals liability plus equity. All right, so assets equal liabilities plus equity. All right, so if we just come down here and start to expand it. So what I'm going to do is, if you just kind of focus on the equal sign, all right, what I want is for everything to have a positive sign. So assets is positive and all these are positive. All right, if they're not positive, I want to move it to the other side of the equation to make sure everything has a positive sign in front of it. All right, so by doing that, what we'll end up with is everything on the left side will be debit, so debit is left. Everything on the right side over here will be a credit balance. All right, so if you look here, so this, all I did here was just expand out the equity section of our of the balance sheet of the accounting equation. All right, so when you think about contributed capital, That just means like our common stock accounts, additional paid-in capital accounts, and things like that. When you think about retained earnings, let me see if I can squeeze this in here. So the formula for ending retained earnings. So ending retained earnings is an equity account. It would be on our balance sheet. Okay, how do we get ending retained earnings? Well, we start with whatever we had at the beginning of the year, our beginning retained earnings. We add to it net income. So if you think about net income, net earnings, that's the same thing. They mean the same thing. So that are earnings. So remember, retained earnings are just earnings that are retained. All right, so here, net income, right here, that's our earnings. All right, the earnings that aren't retained are those that we pay out to our shareholders in the form of a dividend. So net income here is our earnings. All right, the portion that is retained increases retained earnings. All right, the portion that is paid out to our shareholders in the form of a dividend will decrease it. All right, so that's our formula for retained earnings. All right, so we can see here everything, if you're looking right here, everything still has a positive sign, right? So we're good there. So everything still has a positive sign, so we don't need to move anything around yet. All right, so let's come down to this next row and expand it a little bit further. All right, so if you look here, this portion right here is just retained earnings. Now remember, revenues less expenses is net income. All right, just in its simplest form. I know there's more that goes into it, gains and losses and things like that. But revenue less expenses makes up our net income. So what we have here is with this line above it is our retained earnings. All right, so we just expanded it further. All right, so if you notice now we have a negative sign and a negative sign for expenses and dividends. All right, so if we just take both of those and move them over to the other side of the equation, we can see that we have assets, expenses, and dividends all with positive signs over here, and then liabilities, contributed capital, and revenue on the right side. All right, so that means these over here are our debit balances, and these over here are our credit balances. What I mean is their normal account balance for these over here as a debit, and for these over here as a credit. So that means for every asset, every expense, and our dividend account, when we increase it, we will debit that account. And then vice versa for liabilities, our equity accounts, contributed capital stuff, and revenue. All right, so that finishes up this one. The next one, what we'll look into is we'll start getting into the accounting equation and how each transaction affects assets, liabilities, and equity. And then we'll start expanding on that into journal entries, and we'll just walk through the entire process until we create our financial statements and do our closing journal entries at the end of each period.